Emily, good morning, it's Guy. Let's just talk about, a lot of people have been in tech. A lot of people have owned the Magnificent Seven. We're going to get many of these names over the next few days reporting. If tech stumbles, are industrials somewhere that you should look as an alternative? Should you be thinking about rotating your portfolio out of tech at this point into industrials? Should you be thinking about a broader, more diversified portfolio in your equity book? Can you just kind of talk me through kind of where we are now, where we've been, and kind of where we're going, and whether or not this is an inflection point?
Yeah, we look at industrials and mid caps as a great way to diversify from that mega cap tech exposure. As you guys know, we've been overweight technology stocks really primarily as a function of our preference for quality. So we've been looking for sectors and stocks with great balance sheets, tons of cash, good return on equity, low interest burdens. And frankly, the poster child for that has been mega cap tech. But if you look at the returns, of course, on the S&P 500, there's been a lot of ink spilled on this. You know, about 95% of them have been driven by that Magnificent Seven. So while we look at mega cap tech as protecting portfolios from solvency risk, we also have to protect against valuation risk. And one thing I didn't mention about U.S. mid caps with their significant overweight to industrials is they're actually trading at the most significant discount to their large cap counterparts since the late 1990s. So tech for solvency risk and mid caps for valuation risk.
That's so interesting. I don't think I've heard the solvency valuation combo in that. Emily, with the industrials mid cap though, funding issues could be a problem, and how do you manage that? And also, we've heard from some of the big guys, like Fastenal, for example, like they have the order backlogs because people don't want to kind of leave the queue, but the immediate orders might not really be there. What do you make of that?
Yeah, I mean, I think you've got to screen through industrial companies to find ones that are higher quality. We want to find, again, low debt burdens. We want to look for great balance sheets. We want to look for those companies that are really taking advantage of this, again, industrial revolution that's taking place in the United States. Look for those direct ties to the increase in semiconductor production, the increase in EV production, and really identify those names that have the direct exposure there. And look, I'm not saying that industrials are going to be completely immune from a downturn in economic activity. They're not. But on a relative basis, I think there's a pocket of value there that can be uncovered.
Okay. Emily, at the bottom of the screen right now, I've got news that the UAW is announcing that it's going to widen out the strike. We've seen Stellantis news over the last 24 hours as well. These big automakers have big supply chains, and they are the kind of maybe the mid-cap industrial stocks that you're talking about. How are you thinking about the impact that this strike is going to have? Is it having an impact on the way that you would be thinking about constructing a portfolio?
Yeah, again, it's about screening for quality. So the autos haven't been a great investment over the years. That's an area within industrials that we would be de-emphasizing. I think from an economic standpoint, you've also got to think about how this strike potentially plays out in terms of corporate margins. What we're seeing happen right now, and I think one of the reasons that earnings has been somewhat underwhelming, is that we're starting to see evidence that corporate margins are getting compressed. So we know the cost of capital is going up. We understand how that's impacting consumers. It's also impacting margins, as we saw record revenue growth as a response to the fiscal stimulus over the last few years here. That's also coming down. So what's happening is the cost of capital is going up. Record revenue growth is now normalizing, and companies are going to need to contend with that margin pressure by cutting costs if they want to maintain profitability. And we all know that the biggest cost that most companies have is labor. So the strikes are coming at a really difficult time as far as companies who are dealing with this margin pressure and potentially seeing that record wage growth starting to slow today. So I think this is significant, not only from a fundamental investment standpoint, but also from a macro perspective.
So Emily, just take us back to sort of after the bell, guys super pumped for Alphabet and Microsoft. I call it Google here, though, just so you know.
Okay, I think we all call it Google, but they call it Alphabet.
Yeah, I know, but
and
just so
Facebook
you know.
Or Meta.
Anyway, if tech names disappoint, do you have to buy on the dip?
Yeah, I mean, again, we're still seeing some strength here, and it's what do you want to own on a relative basis in an economic contraction? So our view right now is, and we saw this with the PMI data this morning, is the U.S. economy is holding up the best across the globe. That's been our view for a long time, and it was increasingly evident with this diverging PMI data that we saw this morning. But ultimately, the U.S. economy will buckle in the face of higher interest rates. We see that coming going forward. So it's really about what do you want to own on a relative basis? Do you want to own highly cyclical assets, higher beta things, stuff that moves along with the economic cycle in a contraction? Probably want to underweight those things. Do you want to own things with great balance sheets and low interest burdens as we move into this contraction? Again, they may not be completely insulated. In fact, we think bonds deserve a bigger space in portfolios from here. But on a relative basis, those mega cap tech names are going to have that quality element that we want to look for. One last final thought on this, though. Be careful. The Magnificent Seven is going across consumer discretionary, communication services, and your traditional S&P 500 tech sector. Our favorite, the one that's got the most quality in it, is your classic S&P 500 tech sector.